Hi, everyone, and welcome back to another show. My name is Tyler, and I'm with Matt, the founder of ORATS, an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to talk about all of the tools in the options scanner that you can use to help find an edge. Matt, do you want to share a screen and get us started by going over our TLT trades from last week?
Sure. Thanks, Tyler. So we drew a line in the sand. We thought that this was a good place to get long TLT. It's kind of been sitting right here, but I'm still bullish, mildly so. But hopefully we'll bounce off of this. So our trades haven't done too much, just sitting there. Let's see here. So we got a call spread that's down a bit. We're down about $100. So we're hoping for better as people come to their senses and start rallying these bonds. So that's where we are now. And today, one of our favorite subjects is our option scanner and how to get edge using the option scanner, Tyler.
Yeah, I really see the option scanner as part of the core, one of the core tools in our dashboard, because it's the implementation part where you've done your research and now you have a concept in mind, but you're looking for a trade. And oftentimes traders, you'll just pick a delta, or you'll pick a strike price, and you have a general idea of your time frame of trading. But there are thousands, a lot of combinations of trades that you can do, and a lot of choices to pick from when it comes to making a trade. So our option scanner is a great way to pick your trade and get an edge in the process with our theoretical values and other filters that you have in there. There's really a lot to look at here. So yeah, let's get us started, Matt.
Yeah, and with so many different options out there now, dailies, every strike, how do you pick what the best ones are? And this is the way that we do it. So I'm wanting to get short IBIT. I have this is the Bitcoin ETF options, and I'm long Bitcoin, so I want to get short in some options here. So I have a long put spread scan set up, pretty wide variables here, DTEs and deltas, and then long put butterfly, long put calendar. So all these should do well if IBIT goes down. And so the cool thing about the option scanner is that you can rank these and set your rankings here, and it will automatically sort through many differing strategies, differing options, and all that, and come up with the best ones for you. You could also set an outlook of bullish or bearish, and you could choose a stock scan. In this case, I knew it was IBIT that I was going to trade. So that's the brief overview, Tyler.
I want to go kind of step through the option scanner. There's kind of 3 steps there. You can see by the blue circles on the left, and I just want to go through one by one, like the things you can do and what each thing means. We've last week we changed the outlook on TLT that helped us make trades, and there's really a lot you can do in each of these steps. So I just want to go through each one, especially the strategies one, because there's a lot of entry criteria in each specific strategy that I think our users would really like to learn about.
Yeah. So as Tyler pointed out, there's add symbols, and so we could go back to the stock scanner, but we're going to concentrate right now on just the strategy. So not only could you add just typical strategies out here, but you could also put a custom strategy. And I'm going to talk about this a little bit later with what I call the flapper it's the iron condor with an extra on the long on the ratio. But for these, what Tyler's talking about is you could set in these cases. I just want to find the ones with the most edge, and so we calculate theoretical values based on forecasting volatility, on smoothing volatility, and on a distribution that we create based on actual movement. And so we can then look at a bunch of options and weight those to where our theoretical values or risk versus return or other readings are rated highest. And what you could also do is set these DTEs are wide. These are strike deltas here, and there's a nice mouse over. And so I'll take anything with a 30 delta between 20 and 50 delta for the long put, and the short put has to be between 10 and 30. And then I could also, if I wanted to, I could define the spread price as a percent of the stock. So you could, like I often will go negative 0.01 and then a min and max negative 0.5 and negative 0.02 or something like that. So you could.
Yeah, just to touch on that, the spread over stock is otherwise known as spread yield, sometimes referred to as spread yield. Basically it's a way for you to determine like how much money you're getting. Like if you're selling something and you're getting a credit, how much money are you getting versus the stock price? Oftentimes people look for more juice or more premium in the sale of a credit spread, and that's a way for you to sort of filter the trades based on that.
Yep, or the actual price you could use, or the actual delta of the resultant spread. And you could also set how wide you would want that. So it's the option ask minus the bid divided by the strike. And then we have some other thing called a theoretical price diff that actually measures like a put call parity. So if that's too far off, you could filter those out. And then DTE diff. So there's no DTE diff for this put spread, but there is for like a calendar, for example, a DTE diff of 2.
So what's the difference? I think it's important to understand. We get a lot of questions about DTE diff. It's mainly for calendars, right? Like if you're just doing a normal spread, the legs are going to have the same days to expiration. So you have a DTE diff of 0, right? You want min 0, max 0, and you see that in the one that you're on right now, 0 and 0 right there. But if you're looking at a calendar trade, you want there to be a difference in the days to expiration, and this is where you can set sort of your range. How big of a difference do you want there to be in your calendar spread?
Right.
How does that relate to just what makes that different than just setting the target days to expiration?
Well, you want to be able to set a target days to expiration fairly wide, but you might be very specific. You want at least, this is pretty general, just 2 days, but sometimes you might you want exact DTE diff if you're doing like a short-term daily calendar. I just want 5 days. Or you might say, I need at least 30 days, but less than 45 days. Even though my DTE range on the overall might be really wide, you definitely want to be able to set how wide you want your calendars here. So that just gives you some extra control of the spread. Because what happens sometimes, if you come down and you see a trade, you should always say to yourself, why won't I do that trade? Well, it's because it's only 3 days between the long and the short. Well, if you're not going to do it because of that, you should do a setting so then you can bring more options in, and gets rid of a lot of the noise, Tyler.
Yeah, I think that's a great point, Matt. And yeah, we also have earnings as a setting in there. So if you're want to be careful to trade around earnings, you can set the dates in there, which is pretty neat.
Yeah, and dividends. BITO has a huge dividend, so sometimes you want to avoid those. No earnings in IBIT. And then strike widths is the last thing. Is So usually a calendar has a strike width of 0 and 0, but in this case, I said, well, I'll do a diagonal just as long as it gets me short. I'm just trying to find, a good relationship that gets me some short deltas here. And I believe down here you could do some more settings in the table. Yeah, I said it has to be -8, but you bring up a good point. Like a lot of what you can do here is setting the constraints and how you define each particular strategy is very important work on this, Tyler.
Yeah, it's really powerful. So let's move on to the results. So we've talked about theoretical values in the past, but we'll go over them again here. And you can also rank on reward to risk and probability of profit, which we see a lot of users doing as well. So yeah, let's just go over each of those in detail, the three theoreticals and then the three other metrics: delta cost, reward to risk, and the probability of profit.
Yeah, so this is our, so you could sort by rank, and that's what I almost always sort by. You could sort by other things, but rank will then find the top rated ones as to a distribution, forecast, and S, which is our smoothing theoretical value, forecast theoretical value, distribution theoretical value. And like I said, the neat things about these is, and kind of a cool thing we've done because you have a lot of moving parts and a lot of things that are sorting against each other. So we come up with a standard deviation, and then we say how many standard deviations, and we add standard deviations. So it's a little bit complicated, but using that system, we could add up different parts of the ranking and bring you what is the best based on the sliders that you've set. So that's pretty cool. DTC is a little bit harder to understand. It's a subjective look at, sometimes I want to get long deltas, but I want the cost as little as possible. So every delta divided by the cost is all that means. So just delta cost. So it doesn't make a whole lot of sense. It might make a little bit of sense on this one. But it's actually interesting to start looking at that. If you like say, you go in here and you might say, oh, this is the one that I would choose. And then you go, oh, the delta cost on that's really high or low compared to the other one. So, that's the, I wouldn't really call it a theoretical value, but that's another thing. Reward to risk is the maximum profit over a one standard deviation payoff picture divided by the max loss over that same standard deviation. Probability of profit is how much of the returns are positive. So add up all the returns that are positive where your payoff is positive. Max gain and max loss are important. You might notice that I set S percentage of -2 and 2. You might want the best. Like if you were going to trade, you would want a high S percentage. But what I found is that our smooth theoretical value is pretty known by the market makers, and they won't give you too much edge right off the bat. So sometimes it happens, but if it's too much edge, you're probably not going to get filled on that. So that's why I usually put a range around that. Delta, like I said, I know I want to be short, so I want to make sure that anything that comes in here is short. And then what else have I set? I didn't set any. You could set open interest. So some of these have some small open interest, but I didn't want to set that. You could set volume. Does it has to trade today? The ask minus the bid is an absolute. The ask minus the bid divided by the stock price or market width percentage is relative. So I like to put that. So I don't want it too wide. That's 2. I doubt we're going to see that. I should probably have that set at 0.2. And that would narrow some down a little bit. And then what price you're paying or getting. This is more important when you're looking at a strategy like a cover call or something where you want a certain percentage. So those are then we would list out a dividend or earnings here. So it makes it pretty nice, Tyler. All of these criteria.
Yeah, the cool thing is too, you just saw it updated. It updates every minute, so you can just be, looking at it, and you can be confident these results aren't old. That is, as long as you're on the live data plan.
So why don't we do we'll do a put spread, and so we could just check it out all the way through. So this is a put spread. Market's pretty tight. Our theoretical value is now just adjusted as right on the mid price. So, you're getting a decent price. And you could check the smooth edge here as well. And then you could check the payout picture. Behind it is that, distribution. And then if you add up the expected returns of each one, that's how you get the theoretical value of the distribution. And then our forecast is higher. So we think that the volatility in IBIT should be higher than it is right now based on historical volatility and direction and momentum of implied. So we do a lot of that calculation.
Matt, I want to ask about the distribution edge. So we have an option in step 1, which is choose your outlook. And I notice you have all bearish strategies here. Is that something that is a good setting to have if you're scanning for bearish strategies to change that outlook to -5% or anything like that?
Yeah, it depends on your how you like to trade. In this case, when you have so many strategies and so many different expirations, the percent, if you add an outlook to it, it tends to skew towards the shorter term options, picking those, because if you pick a 5% move, for 100 days, that's not that as much as a 5% move in the next 10 days. So that would really throw that off. So I don't tend to, if I have a lot of strategies, I won't use an outlook. But yeah, you're right. If you want to, if in the next, and you have all these set to 2 weeks or something, and you really think it's going to be up 5% in 2 weeks, definitely, I think that's a good way to do it. It'll adjust the D percentage and then help you find the best strategy.
That makes sense. Great. So
let's throw one of these. So slightly out of, actually, it's only 4 days. So yeah, let's do one that's a little bit longer term. Now this one, again, same thing, theoretical values right there. Payout picture looks okay. You could tell the distribution looks a little bit chunky. It usually doesn't, but IBIT hasn't been around that long, so I wouldn't really pay attention too much to the distribution on these longer term ones, and even 19 days longer term for IBIT. So we'll give the market makers a couple cents, and we'll force it, and we'll put this trade on, Tyler, and we'll see how we do next week. Awesome. IBIT is rallied today, so see how that goes. And then I want to go back and look at some other, I promised that I would look at some other scans, using some of the things that you talked about. Here's an interesting one. I think we talked a long time ago. One of my strategies that I like to look at, called the flapper. And the flapper is a strategy, when I call it low historical volatility divided by implied and pretty liquid. And these are all ETFs. And so I like to do a 1x2. So it's two, and again, these are set. This is a custom strategy that I've defined, is buying 2 calls, selling 1. Now a typical iron condor is selling 1 call and buying another call. So you sell the one that's a higher delta, and you buy the one out of the money. I'm buying 2 in this case. So what that does is it cuts down the premium that you're getting, but if the stock really goes one way or the other, you could still make money on the wings. Does that make sense?
Yeah.
So, and you get a credit. So it's kind of like, these are the types of trades that I like to do, where you could win if it stays here, and then you have a a loss area, but then if it goes past your longs, you could start to make a decent amount of money. So this is GDX. You get 11 cents. It's only a $34 stock, so decent. For 12 days, not a horrible return. So I'd be looking at one of these. Sometimes if you're like GDX is kind of dominating all the results here. If you could go up and delete it out of here, so it'll then clear out the rest for other stocks. And in this case, there aren't any that are matching, so we could go look through and see why. Is it a market width? So if I delete that, do any come up? No. If it's a price level, is the price? Yeah, so it's the price. So I had it at 0.09. So if we make it negative 0.08, at least we have one other one here. So let's take a look at that. It's ARC. So 5 cents. I'm not crazy about this one. Why don't we go back and we could re-add it GDX manually, but it would come back in after a few minutes too. So why don't we go trade this one? Go ahead, Ted.
Why do you the payoff diagram looks very similar to an iron condor? Is there a reason you prefer this over an iron condor? Because you're getting less of a credit up front because that window is so small there, that green, but you end up getting paid off way at the wings. Iron condor, you don't. So can you explain that a little bit?
Sure. Yeah. So an iron condor, the shape of an iron condor is this, right? So, so it's pretty narrow, good payoff here, but it never comes back up. If it goes here, you're done, right? Right. In my case, if it continues to go, the red goes up into green on the extreme edges.
So it's a bit like adding protection to your iron condor in a sense.
Yeah, it's kind of turning it into the best of both worlds. You have a small credit, and it's like a long gamma, because if it goes a long way, you can make some money. Mm-hmm. So I think it's kind of a fun, low risk strategy that you could do. And collect, but also if it moves a lot, you win. So you have like two out of three things that could happen. So
yeah, that's cool. So when a lot of people who trade iron condors do like an adjustment strategy. So after a week, they'll look at it and they'll adjust the wings so that they sort of put it back to the center. Is that something you would do with the flapper strategy?
I haven't back tested that, but it really isn't, because you kind of just want to leave it, because if it goes far, if you're right at the, you might get out, because you might get out here before it really drops down. Because even if you go out, near, it's not really getting down to the worst case,
right.
As you get out there, so you're not going to lose that much money. So if you're like, if it's getting near expiration and you're in this area, you might want to exit early. However, it could keep going, and you can win them. You can win both ways. So it's kind of it's a long gamma strategy that you get paid for.
Right. So you don't typically adjust it like you would an iron condor.
You wouldn't need to, because iron condors, they're adjusting it because they've lost or they're losing. So this one you could actually win if it keeps going. So you don't want to adjust it necessarily.
Got it. Okay, and this is on a particular stock scan as well. You're looking at maybe let's take a look at the stock scan to see it's the low HV over IV that are liquid.
Yep. Yeah. So if you go to the stock scanner and you go to your scans and you go to low HV IV, you could see that I've set up the historical volatility in 90 days divided by the 90 days has to be under 7% your way. So the max 93. So it can't have moved too much over the last 90 days. And that's really it. Just HV, and then between certain stock price minimums, and implied volatility has to be not too crazy. So and good, volume, 5,000 average volume. So it's a pretty basic setup, but you just don't want too much HV out there. And so then, it identifies these stocks, automatically brings them over. And like I said, like we've noticed before, the GDX, this looks pretty good. Again, there's a lot of room to win a little bit. And I don't want to do that. I'll give them a couple cents. And that's what I wanted to show from this, Tyler, is making a custom strategy, bringing in a stock scan. So we'll do this trade, and then we'll move on to one more thing I'd like to show our audience here.
Yeah, I mean the flexibility is insane. Like the amount you can do with the stock scan, bringing that over to the option scan, creating custom strategies, and then ranking. I mean, it's so crazy, like the unique things that you can do.
Right. And so then my normal ongoing strategy is a short strangle against a long, more out of the money strangle. And I do a longer term long. So like 5 to 12 days is my long. And then my short is, what is this? 4 days. So, so I'd like to point out, this strategy, we talked about this before too. So I set it up by setting up 1 to 7 days short strangle. My deltas are pretty tight on these. I know I want them to be pretty far out of the money. And then that's all on that. And then I set up, it has to be a S of not too much either side. It's tighter on XSP because it's a tighter market. My reward to risk, I don't want the risk to be too much. These are already getting out there quite a bit. I want a good probability of profit. So all these look like high probability trades. My max loss, I only want it to be $2,000. So that filters down these. My delta, I don't want too much delta. So about 2.5, 2.7 on each side delta. And then what else do I set? I set a maximum price that I want to get is 5%. These are well above those. So these, there's a lot of premium out there right now. So, so these are identifying some pretty good options. So I'm a little worried that we're not going to be able to see these. Maybe we'll have it. I wonder if we could have it expire right on when we're going to be here next week. So let's just try that. So let's see if anything. Yeah. So this is we'll be back on the 13th, right, Tyler? Yeah. So so let's look at the 13th, and then this is the best trade for there, and we'll give them a couple cents. We'll force that, and then we should probably do the long first, but I wanted to show this one off first. So that'll be our short, and now we'll go get the long. So the option scanner makes this all possible. I could have set up also a diagonal, but I like doing them separately because I find myself kind of continuously rolling these and not rolling these. So I end up just doing these kind of separately. So so here's another one on the same day. So this will be good to look at too. So we'll just do an 11 cent strangle, and then I'll show you one more thing. So we only have to give them a cent on this one. We'll put that out. Oops, I want to do a force so we know it fills. And then what I want to do, Tyler, is just show you what it looks like. So it's, we'll go down to XSP and overlay the long with the short. So I have both of them, and you can see that's just an iron condor.
Right. Yeah. Yeah. It's cool. You can overlay your different strategies in the positions table and really see your risk payoff there.
Yeah, definitely. And that's all I got, Tyler.
All right. Yeah. Great episode, Matt. Thanks for Thanks for sharing all the tips and tricks for the option scanner. There's a lot to tackle there.
Well, thanks for putting all these great tools together. We've had a lot of blood, sweat, and tears over the years putting these together, but great tools.
Yeah. If you guys have any questions, just leave a comment in the YouTube video, or you can email us at support@orats.com. We also have extensive documentation on our university, which is also available on our website. And there you can learn about the theoretical values that we talked about in this episode, as well as many other techniques and methodologies that we've developed at ORATS. Thank you guys for watching, and we'll see you again next week.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.